And going back to currency hedging, one of the things we didn't touch on was currency forwards, forward contracts. Can you just talk us briefly through what a currency forward is and how they can be used for businesses to manage their foreign exchange exposure, and also, say, for an individual who's got a large foreign purchase up, maybe a villa coming up in 6 months to a year? How can business and private clients use currency forwards to help hedge their exposure?
Quite straightforward. I mean, we use forwards all the time on, particularly with your second example there on the property purchase side of it, and on the business side as well. But so what the client would basically do is if they were perhaps selling a property in the UK to purchase that property overseas, and they were quite late in the property sale process, and the exchange rate was at a good level, or perhaps they were concerned about sterling depreciating any further and the price getting worse, and the property sale that they were buying essentially getting higher, what they can actually do is they can lock in the exchange rate today, so to speak, by placing a 5% notional amount against the forward contract. That price is then secured for them for the duration of the contract. The contract could be anything up to a year. So basically what we'd do is we'd lock the price today. Just say, for instance, if the property sale was going through and they think they would have the money within, say, 2 months' time, we lock the exchange rate in for them. We essentially pre-buy those euros on their behalf, and then they would pay us the 5% deposit, and they would pay us the remaining 95% on the maturity date, so when they actually got the funds through. So even though they might not have all the funds in place, there's still those kind of tools will enable them to take advantage of the exchange rates without actually having the funds in place.
So they're protected. So
exactly.
So that foreign currency is not going to cost them anymore.
So for that duration of the contract, irrelative of what happens to the exchange rate, if it dropped by 5%, it doesn't matter because we've already pre-bought it and it's secured and locked in for them.
Okay, super. And what about businesses? Why is it so important for businesses to effectively manage their foreign exchange exposure?
Mainly because these businesses will be working on profit margins. We deal with a lot of fruit importers, travel companies specifically, very tight margins, as well as the fruit sector as well. So when they're pricing up their products, they will have a profit margin locked in. What they don't want to do is the exchange rates to move over the duration of the year and their profit margin to depreciate, or worse than that, when the prices move aggressively and they haven't locked in, they might have to reprice to their customers, which is not a scenario they want to be in. Sure. So by doing a forward contract, what they can do is, if the exchange rate's at a good level, they've got a good profit margin locked in, then they can actually keep that profit margin for the duration of the year by booking out a forward contract and just making it secure and making the profits of the company solid and guaranteed.
Sure. So that's of course the benefits of hedging, of currency hedging, is that you limit your exposure. But are there any downsides to using currency forwards and hedging tools?
The downside with a forward or a hedging tool is if obviously the market doesn't go your way.
Yeah.
If you did a forward contract for a period of time and then the market didn't move the way you thought it would move, so if you bought euros forward and then the price carried on moving higher over the duration of the contract, obviously that wouldn't work out well, which is why one of the best strategies we tend to use with the client is if they do a 50% hedge. Just as an example, if they did a 50% hedge out 1 year, when they come to actually making the payment on a monthly basis, if the spot market was higher than where their forward price was at, you simply buy spot to increase your average. But if the price was lower, then you can actually draw down off your forward contract. Okay. So what you've got the cover in place, but come the end of the year, you should end up with a much better blended level, but still enabling you to increase your average.
Okay, all right, that's brilliant.